Mortgage rates remain near historical lows due to the Federal Reserve's efforts to boost the economy during the pandemic. Even after climbing earlier this year, mortgage rates are still much cheaper than they've been in years. But whether you should take advantage of that cheap money depends on your situation. If you're in the market to buy a house, ultra-low rates could mean you can afford a nicer home for the same monthly payment. But there's a catch. Home prices are soaring in part because rates are so low. Nationally, home prices hit an all-time high, but sales of new homes fell in June to the lowest level since the first month of the pandemic in early 2020, as high prices and limited selection frustrated potential buyers. On top of that, high housing prices make it harder to make the 20% down payment that's required to avoid private mortgage insurance. So before you make the decision, make sure you do your homework and figure out exactly what you can afford. If you currently own a home, low rates could mean it's a good time to refinance your existing mortgage. That means paying off your current mortgage and ending up with a new loan that charges a lower interest. Just make sure you read the fine print and do the math before you sign for a new loan. Factor any closing costs into your calculation. And look at the timeline. Will you opt for a mortgage with the same or shorter term than your current one, or will you extend your years of debt? A good rule of thumb is to refinance only if you can reduce your rate by 0.5 to 0.75 of a percentage point and plan to be in the home for more than 3 years. If you want access to your home equity but don't want to refinance your existing mortgage, you could take out a standard home equity loan. It's basically like a second mortgage secured by your equity. Lenders usually limit the total amount you can borrow, including your primary mortgage and the equity loan, to 85% of the equity in your home. If you decide to go this route, watch out for high closing costs, and keep in mind that you might be forced to take out more cash than you need. A final option to take advantage of this low-rate environment is to take out a home equity line of credit, or HELOC. It's sort of like a credit card, but with a much better interest rate because the debt is secured by your home equity. You borrow only what you need when you need it, and you typically can pay it back over many years. HELOC's ready access to cash can be a helpful piece of a financial safety net. A final thing to keep in mind, low rates can help you borrow on the cheap, but getting a loan is not guaranteed. Given the uncertain economy, lenders have tightened requirements. So before pursuing a new mortgage, equity loan, or HELOC, check your credit score and talk to a financial advisor to see what makes sense for your financial situation.